Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to all the trade day team to the Wednesday, the 3rd of September, just slightly late running Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. I'll go through our usual regular run through in here today. Keep it fairly brief. The main focus on the Treasury bond, actually global bond markets, not just the Treasury bond market, global bond markets in here today. From since we restarted after the US holiday yesterday, those higher yields we're seeing, particularly the long ends, concerns about global debt, it's concerns about the global economy, meaning we're seeing a march to higher yields. So bonds are selling off, going to higher yields at the long end, not 10-year, this is beyond 10-year, 30-year bonds, 20-year, 30-year bonds. We'll talk all about that in a second and go through some more details. That's actually easing off over the last 12 hours or so. So post the US close, the markets have kind of eased off, actually through yesterday's session as well. So bond markets have kind of actually moved slightly back down to slightly lower yields. Globally, that's not just the US, that's globally, which has meant stock indices have managed to have a slight rebounds in here today. Let's look at the calendar before we get to all of that. So because the US is effectively like a day behind, we're not getting we're getting already the service sector and composite sector, the composite PMI data from the global economies, but the US is a day behind because of the Labor Day holiday. So we've already had in here this morning these out of Asia, and you can see in here out of Europe. I kind of mixed in here. So France slightly beating expectations on the service sector in here. And then we had 3 in here from Germany in the Eurozone, slight miss. And then we have from the UK's beats on the composite and the service sector. So I kind of mixed in here from Europe so far, but because those bond yields have eased off, and potentially because of a combination of this data in here being slightly positive, we've seen European equity markets go higher and bonds ease back from their higher yields to slightly lower yields in here today. Going into the day, we do get factory orders today at 10 o'clock Eastern, but more important is the JOLTS job opening. We're going to be watching that. Kashkari speaking at 1:30. So 10 o'clock factory orders, but more importantly, the JOLTS job openings. And then we get Kashkari speaking at 1:30. Those are all Eastern time. Remember, regarding the Fed speakers, his blackout period starts this weekend. Okay, so on Saturday. So we only have today, Thursday, Friday, where Fed speakers can speak on monetary policy. So that's interesting to note. Let's start off with the morning briefing Americas from Bloomberg in here. So China Z hosts Putin and Kim at military parade. Nothing really impacting onto markets that we're looking at. The main real thing in here is this global bond. So initially renewed selling pressures, but then we've actually seen bonds slightly rebound. That's higher prices, lower yields. But you can see in here, cost of lending for Japan's gone up for 20-year, advanced to its highest level since 1999. So the 20-year bond there, I'll just run through these in a second. I've got some of these bonds, I'll pop them out. And then also we've seen, yesterday I said, since 1998 on the UK 30-year bond is at its highest yields. And Treasuries, net 30-year yields climbing towards 5%. However, they have kind of reversed a little bit now to higher price yields. Oh, let's just see my screen stop sharing there for some reason. Let me reshare that screen. So then we've seen a slight move from back to lower yields, and that's helped stock indices, certainly in Europe and on the futures on the overnights in here. We've seen a rebound before the cash market opens. So just running through all those headlines, global bond sell-off deepened. So that initially deepened overnight, and from yesterday, but now we're seeing a stabilization. Again, in here, Japan's long bonds to join global sides of politics adds to jitters, and we see here there's the 20-year bond in Japan, shooting up in here over the last few weeks and yesterday, and at high yields in here. And you can see, as far back as I've got data in here, and it's back to these levels here. So it's like 98, 99. So it's the highest levels for the Japanese 20-year. And we spoke about the UK in here, so you can see in here UK bond yields yesterday shooting higher at the 30-year, and you can see at highs not seen in a year. We actually haven't got the data going back far enough. But for data, let me see if I'm actually change it to the monthly chart. Was that giving me further data? No, I don't think it's going to give it to me. No, we haven't got the data going back. But rest assured, that is the 30-year in the UK, its highest level since 1998. Treasuries joined global sell off with 30-year near the 5% level. We can see that here. So you can see yesterday the 30% actually just pipped above 5%, and actually just got almost exactly fell right at 5% actually. And we're actually now back slightly lower in yield, backing off from that 5% level in here. And the markets are just watching that everywhere. So look, morning big US long bond yields test 5% again. That's the 30-year. Stock bulls cast wary eye on global bond slump as Fed looms. So obviously the Fed next week. And what we're seeing is there's a disconnect. So we're seeing the yield curve steepen. So short end, what we're seeing is the short end yields are remaining low. Because there's an anticipation of rate cuts, and we'll see that on the Fed Watch tool. And when we come to look at the US Treasury bond technical analysis from market charts, you'll see the shorter ends remaining bullish. Because remember, the shorter end of the bond markets, the 2 years out to maybe the 5 years, more sensitive to what the Fed are going to do, what they're more sensitive to interest rates globally, where the long end is more concerned about inflation, it's more concerned about the strength of the economy. And what we're seeing is concerns about government debt, particularly, and rising government debt globally, and is that going to be able to be paid off? So we're seeing longer bonds, 20-year, 30-year bonds selling off, and that means higher yields. Okay, and we'll look at that as we go through here. So bond route cools, so that's what we've seen. It just kind of edge back from those higher yields back to slightly lower yields, but mood cautious with long-term borrowing costs near highs. And then again, look, stocks find footing as global bonds sell off slow. So stocks have kind of rebounded a bit this morning. And then through all of this, gold is hitting a record high because, it's a safe haven. If you can't own stocks because you're worried about bonds, and you don't want to own long bonds because you're worried about the governments, right? Where do you go? Safe haven, gold. So that's why gold's at an all-time high and making new all-time highs. And S&P and Nasdaq futures gain after. And then also we had a rebound as well. This felt helped by this. Alphabet antitrust ruling favoring Alphabet, and we saw Alphabet/Google jump yesterday, and then jobs data on tap. That's the JOLTS report we've got coming up. So we look around the world globally. Asian equities actually suffered on the back of, obviously, US equities were down, so they were down. The Nikkei down 9/10, and the Hang Seng down 6/10. But if we look at European exchanges this morning, because we've seen that slight recovery in the bond markets to lower yields, you've seen European bond markets rebound, having got hit yesterday. So the UK FTSE up 0.5%, the DAX up 0.75%, and the CAC nearly up 1%, up over 9/10. And that's also being seen in US equity futures this morning. So the S&P 500 up 0.5%, and the Nasdaq up 0.75% this morning. Looking at the Fed Watch, well, this is what we're talking about. So the market's still very much nailing on a rate cut at the September meeting next week on the 17th. So we're looking at nearly 92%. And then into October, we're kind of 50-50 between either not getting another rate cut in October or getting a second rate cut. But by year end, we're certainly nailing on, pretty much nailed on in here. This is the percentage for just one rate cut. So you see 15% for one rate cut in total. So the market pretty much pricing in 85% chance that we get two rate cuts, and there's a 37. This is actually moved up, so 37% chance nearly that we get a third rate cut. So we get three rate cuts this year. Let's look at those treasury bonds, and this is what we're talking about in here. So look, the 30-year, you can see moving to recent lows. That's pushing at that 5% level in here. So that's remaining bearish in here, and 10-year in here though more bullish. Okay, so the 30-year in here we've got a bearish view, but the 10-year is holding on to a bullish. We have moved to lower prices, but if we look at the 5-year, even though the sell-off, it makes much more bullish. We're only making new highs only recently, and the 2-year similarly. Yes, we've had a sell-off, but the 2-year remains bullish. So this just shows you the short end bullish on price, that's maintaining a lower yield bias, where the long end's going bearish in price, which is higher yield bias, and the yield curve steepening. And what do we think about on the stock indices? Well, we have taken out some support in here yesterday. You can see in here on the S&P, we reversed that trend line, and we're down playing with this support level in here 23,035 in here on the Nasdaq, but obviously the rebound this morning has helped us away from that. So the sell-off that we've seen in here, not quite shifting us to a bearish view in here. If we take out the recent lows in here, it switches back bearish, but obviously we're rebounding in here today. So at the moment, we're clinging on to a more bullish view. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. You might want to keep an eye on those long bonds, the 30-year bonds, and making sure that they're not moving to higher yields. If they start tracking up to higher yields again, going up to that 5% level on the 30-year, then that could be signal a more. And so then you'd be going back in here looking at on the 30-year and here on the futures, you're looking at these support levels. So looking down here at maybe 113.07 and lower levels in here, maybe towards 113.00 on the US 30-year bond on the December contract, just watching out for those support levels. If they start to go, that means the yield is going above 5%, and that's going to put downward pressures on stock indices. So keeping an eye on, I would say that the 10-year not as important at the moment, the 30 years where all the action is. So keeping an eye on that 113.07 and 113.00 level on the futures, or if you've got the bond yield chart, watching the 5% level on 30-year bond yields. And don't forget as well then, where are we? At 10 o'clock Eastern, we have factory orders, but more importantly, the JOLTS job openings, and then Kashkari at 1:30. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe, and we'll be back with you with another Bull versus Bear webinar tomorrow. Bye.